Good morning, and welcome to the Energy Perspectives Group webinar hosted by ROK Resources. This event is being recorded. During the presentation, all participants will be muted. If you have any questions you would like to ask, please type them into the chat feature. We will read and answer questions at the end of the presentation. Thank you so much for joining us today. Now here is Dan Steffens, who will introduce today's speaker.
Good morning, everybody, and welcome, and thank you for attending this webinar. I'm very excited to have ROK Resources here. It's one of the companies in our small cap growth portfolio that I started following over a year ago, but it's a Canadian junior upstream company that's in our small cap growth portfolio. ROK was co-founded in 2019 by Cam Taylor, the company's chairman, Bryden Wright, the company's president and chief operating officer, and Jared Lukomsky, the company's senior vice president of land and business development. So ROK Resources is based in Regina, Saskatchewan, that has generated strong production growth since I started following it. Soon after they formed the company, we had the pandemic, so they didn't do much until, just recently, but they made two strategic acquisitions, one in March of 2022, and then another one in January of 2023. That brought in production of over 4,000 barrels a day. And then they followed that up by a non-core asset sale in April that reduced production by only 8,000 BOE per day, but generated enough cash proceeds to pay off all of the company's senior term debt. And I thought that was just an incredible deal. Basically, ROK ended up with 80% of the production that they acquired for a fraction of the price they paid for the two acquisitions by paying off all that debt. Then their summer 2023 summer drilling program, which kicked off in June, resulted in 41% production growth from 3,297 BOE per day in the second quarter to 4,650 BOE per day in December, which was above their production target exit rate. They replaced all of the production that they sold in April 2023 with half of the wells that they completed during the second half of 2023. So just in 6-8 months, they more than replaced all that production that they sold. I really like the company's production mix. Their fourth quarter production mix was approximately 50% crude oil, 10% NGLs, and 40% natural gas. And with the low natural gas prices, liquids provide well over 90% of their fourth quarter revenues. So ROK's revenues are heavily weighted to oil sales in the past, and going forward they will be. So joining me today are two members of the company's management team, Bryden Wright and Jared Lukomsky. I hope I'm pronouncing that right, Jared. But yeah. Bryden is the company's president and chief operating officer. Prior to co-founding ROK, he was on Cam Taylor's management team as vice president engineering on a company called Villanova for Oil Corp. He has over 13 years of experience in the Williston Basin oil exploration and production, specifically Southeast Saskatchewan, conventional and unconventional oil plays. He holds a bachelor's in petroleum systems engineering as a registered professional engineer. And Jared is the senior VP of land and business development. So in addition to being the co-founder of ROK, he worked with Cam Taylor and Bryden as vice president land for Villanova for Oil Corp. And prior to joining the Villanova Group, Jared was employed by Conexus Credit Union from 2000 to 2007, where he managed a book of business in his role as a commercial account manager. So I just want to remind everybody that during the webinar, if you have any questions, please type them into the chat box, and then we'll answer them at the end of their presentation. But with that, I'm going to turn it over to Bryden for an update on ROK Resources. All yours, Bryden.
Yeah, thanks, Dan. Appreciate the thorough intro. So I will flip it to the next slide if I can here. So you gave a good intro to our team. I think a lot of your members are familiar with our team. Cam, our CEO, Jared, and myself, like you said, have worked together since about 2006, and then Lynn joined us when we went public, and he was formerly with Petro-Dorado. So he's our CFO out of Calgary. And Cam, Jared, myself are based out of Regina, travel back and forth from Calgary quite a bit. So you already mentioned our previous experience with the Villanova Group. So we come from the private sector. That's our history. We've built and sold companies in the private space in Southeast Saskatchewan from around that 2006 time where we started Villanova Energy Corp. Sold that in 2009, and then we subsequently built and sold 3 additional companies, all based out of Southeast Saskatchewan. For roughly about a 3 times multiple for investors. So again, it was in the private space when, access to capital was a little bit easier, on the private equity side. And we made the decision in 2018 to go public, rather to create ROK and then go public in 2020. And, we haven't looked back. It's been a pretty great journey thus far. And I'm going to walk you through our results in 2023 and how we see 2024 looking. So as far as the asset base, you had referenced 2 acquisitions that we did. So the big acquisition we did in 2022 was we purchased all the assets from a company called Federated Co-op Limited. So they're a big cooperative in Western Canada. They're about an $8 billion company, and we purchased all of their upstream assets in 2022. And so that gave us a presence in Southeast Saskatchewan as well as Kaybob. And so since then, we divested of some Southwest Saskatchewan assets. We did an asset swap with Whitecap. We picked up additional assets in Southeast Saskatchewan to grow that area. Again, that's where we have, the bulk of our experience, and that's where we're focusing our drilling dollars going forward. So we've now grown that to, I think we peaked at about 3,400 BOEs a day. We're just under 3,000 today. And our Kaybob assets, it has, it's a gas-weighted play. There's significant upside. I think we have over 80 sections of land, only about 15 booked locations there. So it's an area of upside potential. Capital allocation there has been quite light thus far in the company. The cost per well is a little bit higher out there. Reserve base, has a lot of room for growth, but I think at higher pricing is where we would look to allocate capital in Kaybob. So we currently sit at about 4,200 BOEs a day. We exited at over 4,600. We exited 2023, and I'll walk you through our first half plan. But it's when we came out with our guidance for the first half of 24, it was a bit of a pullback in capital allocation in light of gas prices, in light of the success we had at the end of 2023, where we spent a little bit more capital. We kind of pushed a little bit more capital into Southeast Saskatchewan than planned. Had some success, which I'll walk you through. And so the plan for the first half of 24 has been to reduce our debt. We're looking to exit the first half at around that $12 to $14 million in net debt. So a reduction of about $5 to $7 million in net debt from year end. As far as, the milestones that we've reached in this company, we went public in 2020. We were pretty stagnant or inactive, at least at the drill bit, for the first 2 years. We did some small acquisitions. We acquired about 150 barrels a day the day that oil went negative in 2020, and that was for nothing. And then the big transaction again in 2022. So really, we've been active for about 2 years, and since then, we've done, I want to say, 4 acquisition or divestitures, 4 transactions. We've gone from 2,900 BOEs a day up to 4,600 BOEs a day. In the meantime, we've reduced our debt significantly. We're sitting at about 0.5, 0.6 debt to cash flow today, with a significant asset base and significant room for growth in Southeast Saskatchewan. In 2023, we were able to completely retire our term debt. And so now we sit with just a revolving line of credit, $22.5 million line of credit with National Bank, with about, I want to say, $15 or $16 million utilized today. In December, we drilled the best oil well in Southeast Saskatchewan. It was over 400 BOEs a day, 392 barrels of oil a day. So a nice Frobisher well that sets up some additional drilling in that area. And again, the way that it trends geologically in Southeast Saskatchewan, we've identified some additional targets, similar to this, that we'll look to deploy capital on this year. So, we had a very successful second half drilling in 2023. I think we were down to about 2,900 BOEs a day after our transactions. and we grew, by 1,700 BOEs a day through the drilling of, I think it was 12 gross locations. So it was, very successful. The bulk of that was oil. We did drill one well out. We were 30% of a partnered gas well in Alberta that came on at around 700 BOEs a day, 80% gas. So that was a success, an absolute success. But again, in light of gas pricing, it's not an area that we're looking to allocate capital this year. So as far as this year's first half forecast goes, so again, we aren't drilling. We actually haven't allocated any drilling dollars in the first half. We've been focused on reactivations. We have about 60 locations in Southeast Saskatchewan that are reactivation potential, and a lot of these came from the FCL transaction as well as the Whitecap acquisition. So we actually completed 12 of those in this quarter, and we're looking to do an additional 10 over the second quarter. We may look to allocate some drilling dollars right at the end of Q2, so in May or June. But as far as this forecast that you're looking at here, it's really just focused on debt reduction, and we have no new wells planned until July 1st. And again, I think that may change. I think we may get out post breakup and get the drilling rig moving a bit quicker in light of pricing. So I do think that we'll see improvement to this. But we're forecasting about $15 million of NOI over the quarter, which equates to $11 million of funds flow. And that's only with $4 million of CapEx. So it's a very, very muted CapEx budget. We would look to exit at around that $13 million of net debt at the end of the first half. Our intent is to release a second half budget sometime in April. And so we'll have that. We're in the midst of preparing that. And obviously the recent run up in oil prices is well timed for us, and we have a lot of locations in Southeast Saskatchewan that we want to get drilling on. I won't spend too much time on our cap table, but we have currently 218 million basic shares. We have public warrants that do trade. Those expire in March of 2025, so those are coming due in about a year. Those have an exercise price of 25 cents. And then we have some more options as well. So fully diluted at about 350 million. The warrants, if they are all exercised, would bring in about $28 million of proceeds. That's just for the publicly traded warrants. Obviously they're trading at 25, or the exercise price is 25 cents. I think we're trading around that 28-cent price today. So, we either bring in the capital over the course of the next year, or those expire without capital coming in. So I think either way, we definitely have a use of proceeds. But if the capital does not come in, obviously our basic share and our diluted share count is quite similar. One thing I will note, management and board, coming from the private sector, we're very, very incentivized from a share ownership perspective. Jared, myself, and Cam were the founders. We funded the company, kind of bootstrapped the company for the first year and a half, and then we're able to go and raise some capital. But we own with the board about 17% of the company. I believe Cam's the largest individual shareholder, and Jared and myself are not far behind. So we've always been aligned with shareholders. We've participated in all of the capital raises throughout the company. Cam's also participated in early stage debt financing for the company. So I think we're as aligned as any management group out there. So here's a snapshot of our Southeast Saskatchewan land base. We have in Saskatchewan about 282,000 gross acres, 122,000 net, the bulk of which is Crown. And so in Saskatchewan, the Crown acreage carries incentives, royalty holidays that are quite important to the economics of our wells. So we have in the first 37,000 barrels that you produce on a horizontal well, it's at 2.5% royalty. So, very, very attractive economics on Crown land. And then the other remaining is at freehold, and those royalty rates would vary from 15 to 20%.
I think it's important to note, if I may, Brian, that this continues to be our hunting area. So it's an area that we're continuing to grow. It doesn't necessarily get press released. So we're participating in Crown land sales, looking to lease strategic freehold. And then targeting areas that, we believe we either need infrastructure or, to extend a play that we understand, that we've drilled some exploratory wells. So we're continuing to add to this acreage that we think is strategic and, ultimately we think will provide value in the future.
Yeah, I agree, Jared. And the one other thing in the fact that we have been able to do acquisitions, acquire, new infrastructure from companies like Whitecap. We have not built or have not needed to build a facility yet in the 2 years of operating. We have a bulk of facilities and easy, quick tie-ins for all of our locations. So, it's an advantage of going out and doing, smart acquisitions in key areas where we continue to grow. So we came out with our reserve report recently. We have, I want to say it's about 130 booked locations total. We're showing 117 on this slide, which is, basically covering our core areas in Southeast Saskatchewan. And you can see, the boxes. Steelman's an area that, if you're following companies like Surge or Whitecap, they've been drilling some significant Frobisher wells in the area, 200 to 400 barrel a day IP30s. Really, really attractive area that we have some land, and we've drilled, I think, 3 wells to date. One of our better wells in 2023 was drilled in the Steelman area. And we do have, capital allocation, assigned to that area coming up in 2024. The other area that we've been focusing on and our best well to date was drilled in the Glen Ewan area. So we do have, again, we have multiple booked locations there, all Frobisher, a few Midale prospects. But for the most part, as we look into 2024, the Frobisher, which is a conventional light oil play, where we can drill wells, single legs for about $1 million, 1.1 million, dual legs for 1.3. I have a slide here that shows the payouts and the economics on a per well basis, and they're significant. So I think they're right behind the Clearwater as the best play in North America for light oil.
Before we move on, Brian, I just want to touch on that best well in Saskatchewan in December. So that asset, that was the first asset acquisition we did when oil touched negative $38, paid essentially nothing for it. And I think it really highlights the strength of the team, which is going out and identifying sort of overlooked assets and then deploying capital on it. So acquire that asset for zero, assume the liability piece, roughly 150 barrels a day. And that asset is probably doing 600 barrels a day of oil today. And again, we believe we've got future locations to drill as well. So again, I think it just highlights the technical ability of the team to go after some of these overlooked assets.
Yeah, and further to that, as we step out and drill, offsetting analogous targets, we're going to move to the southeast, and we have identified targets that would fit a similar, geological nature to the Glen Ewan Paulbright Huntoon that we've already chased, down into the Workman area here, just south of Cardiff in an area called Souris Flat. So as we get closer to the U.S. border, which is right on the southern portion of this map, that's where we'll look to allocate some dollars this year. And the one thing too I'll note on that is all of that is unbooked. So we have reserve growth that we're going to be really focusing on this year in the second half. No different than this past year. I think converting 1P and 2P into PDP is important for ROK. We were able to do some pretty great things from a debt reduction standpoint, but the trade-off there was our PDP reserve. So converting that, drilling some unbooked areas, drilling some 2P areas, and converting those to PDP is going to be important. So on the Frobisher, this is our typical type curve. So our reserves type curve in green, forecast type curve, which is roughly 10 to 15% below that. So you can see at $70 oil, you get a NPV10 of 1.2 million, IRR of 100%, and a payout of 1 year. So, we're sitting at above $80 today. You're seeing payouts of sub a year on wells like the one we just drilled in Glen Ewan. We'll see a payout on that in probably 4 to 5 months at current pricing. And, recycle ratio is well above 3. So, it's a very attractive area. It's geologically complex, and there's a lot of risk associated with this. It's not everybody's cup of tea because of that. You have to have a very solid geo team. You have to understand the basin quite well. But when you're able to find and put together a number of these plays, The economics are far superior to a lot of other plays where, you know, you have to frack or, you know, they're unconventional. We have about 25, I think it's 27 booked locations in the Frobisher and 15 unbooked locations. So we're looking to obviously grow that to my previous comment in the unbooked areas. So I guess the sister to the Frobisher would be the Midale. So the Midale has historically been chased in southeast Saskatchewan since the 50s. It's a solution gas reservoir. You know, there's multiple zones of dolomite, limestone, Mississippian formation or Mississippian timing, but it's a longer life, higher EUR play. And so the economics, you know, a lot of the areas now we chase are either exploited by multilateral or fracs. And so it's a mixture of those two, you know, two propositions. And we're looking more into the multi-lat nowadays. But historically, we've chased this with fracs. So it's about a $2 million cost all in. And again, at $80 oil, the economics are quite solid. You know, 60 to 100% IRR and recycle ratios of 2 to 3. So, you know, again, it's the benefit of the Midale is you can water flood this pool or this reservoir. And again, the EURs on this are quite strong. You can see up to, you know, 80 to 100,000 barrels per well in some areas. We won't get into detail on our reserves, but we did have a reserves update. We were able to see, you know, slight growth from. So, I guess I'll go back a step. So we did our year-end reserve report last year. We then had a number of transactions through January through April. So we look at April 1st as more of our scorecard, you know, post transactions. What have we done since then? So we were able to grow our PDP base, replace it with slight growth. We were able to increase our 1P reserves significantly. Our 2P reserves dropped just slightly, and that was more of a result of converting a lot of those 2P into 1P, which is obviously a goal of ours. And then losing some 2P locations out in southwest Saskatchewan where we have no plans to deploy capital currently. So really, it was a focus on PDP and 1P growth, which we were able to obtain. Obviously, pricing. You know, pricing is the one thing we can't control. You know, when we start to see oil above $80 again, you start to see your NPV10s increase significantly, and that's a focus of ours this year is to to grow the reserves. You know, try and take advantage of higher pricing, both at the drill bit, both on our cash flow, but specifically on our reserves. So as far as our stock and our company and, you know, why are we attractive? How do we trade compared to peers? So we trade at, I think, just sub 2.5 times cash flow today. So we're definitely on the lower end. I know Dan and I were talking before the meeting and, you know, the metrics and the multiples we're seeing today are the lowest we've ever seen. It's pretty incredible at, you know, what we trade at compared to historical, you know, oil and gas metrics. So, you know, we're trading in that 2.5 times cash flow range. We do believe that, you know, we're going to see some increase to that over time. 0.6 debt to cash flow. So again, we're very, very cognizant of our debt levels. We don't like to see ourselves get more leveraged. You know, we want to stay below 1. That's our target, and I don't think we'll see us, you know, go above that over the short term here. Again, we're $22.5 million line of credit, and we're sitting at about $15 million of that utilized today. So our share price, you know, shows since inception, you know, have taken the share price from around that 10 cents a share range up to, I think, a high of just under 60 cents, and then pulled back into that 30-cent range over the last year. You know, the 2022 was a great year, I think, for the sector, for us as well. 2023 a little bit more challenging in terms of capital, you know, coming into the oil and gas sector and oil and gas market. But as far as what ROK has been doing, we're focused on our operations. We've been focused on our op cost reduction, which we were able to do in Q4. We were able to take our operating costs from $36 post transactions down to about $29, $28. So that's a focus of ours. Obviously, growing per share growth is going to be the focus of ROK going forward. And I think we're trading at a multiple right now and at a value where we see significant upside in the stock. So as far as some catalysts, I think right now we're kind of halfway through a first half where we've been focused solely on debt reduction and trying to rein in our operating costs and things we can control in the field. I do think we'll get out there and start drilling a little bit sooner than predicted. So hopefully in May or June. And then the second half of the year is going to be a busy one for us again. And I do think we'll start to see some, we'll get a drilling rig going in Southeast Saskatchewan. We have some partnered wells that are planned, some non-operated wells in Southeast Saskatchewan as well. And obviously we'll take advantage of the pricing that we're seeing today and, look to grow in the second half of the year. So, one interesting little side story to ROK is our lithium asset. So this is an asset that Cam Taylor had identified probably about 2 or 3 years ago. So there was a lot of work being done in Alberta, a company called E3 Metals, as well as some work being done in Saskatchewan at the time on subsurface lithium rights. And so Cam had identified this. We did a big kind of geological workup, and we're able to obtain a partner to go and acquire some subsurface rights. So fast forward to today, and we have, what's the number, Jared? 200,000 acres, I believe, of land.
Yeah, we have 200,000 acres of subsurface dispositions, the bulk of which are crown, 95% are crown, and sort of 3 core areas, the Manser, Viewfield, and Taivan area. Manser, we've tested 2 wells, tested lithium concentrations as high as 148 milligrams per liter. And then the Viewfield area, which has been sort of our focus over the last 12 months, largely because of the results, where we have drilled and tested 2 horizontal lithium wells, which tested lithium concentrations as high as 259 milligrams per liter, which started to generate attention because those are the highest lithium concentrations ever recorded in lithium brine in Canada. So obviously pretty exciting for us and the lithium piece of our business. I've said it before, this is sort of sat in our appendix over the course of the duration of ROK, but we've been forced to kind of move it forward because we believe that there's real value potential for our shareholders, and we continue to inch this forward. ROK is the operator of this asset, so we control the pace of capital. We now get paid to do that. We get paid roughly $50,000 a month, so reducing ROK G&A. And again, we own 25% of this asset through the company, a private company called Hub City Lithium Corp. Brian, you want to touch on the PEA a bit?
Yes. So the biggest, milestone in the lithium operation has been the release of this PEA. So preliminary economic assessment, kind of like a reserve report in the mining space. So we released a PEA whereby we had an NPV8 of $1.5 billion, IRR of 55%, which is, and that's based on a capital exposure of 570 million. So there's a number of projects that have been, PEAs have been released on a number of projects in Canada, and ours is, best in class. We're one of 2 best in class in those as far as operating costs, what the NPVs look like, and the IRRs. And so because we've drilled the best well to date as far as concentration goes, it's really just comes down to subsurface. What are the flow rates going to look like? What are your op costs going to be long term? And then at the end of the day, who's the offtake agreement with, and who's your buyer? So, there's been a lot of downward pressure on lithium prices. I think we're sitting in that $15,000 a ton range today. And, given that we have some of the lowest operating costs in Canada, if not in North America, on lithium brine specific, definitely puts our project in a really good spot. So, we don't spend a lot of time on this. Technically, we're partnered with a company, EP Metals. They've now began hiring a technical team. So, ROK's time and energy is spent on oil and gas, but this is a pretty high potential project that we hold 25% of, and we'll be looking to quantify that over the course of the next year, and hopefully get that in the hands of shareholders in some manner. But it's like Jared said, it's been in the appendix. It's been a free option for a long time for ROK shareholders, and at some point we'll be able to monetize that for everybody.
I want to mention too, I think there's external things to ROK that continue to validate the lithium market that we're seeing specifically to Saskatchewan. We're seeing consolidation happen. We're seeing continued capital. We're seeing potential global capital be attracted to the lithium space in Saskatchewan. And again, our view was to own the best resource. We believe we've done that, and now it's about finding a way to crystallize value for shareholders.
On peer comparison, just a snapshot of where our project sits compared to peers. So highest concentrations, second lowest operating costs, and then on the NPV and IRR, we're the second best. So again, very attractive. There's a lot of capital being, capital and time and allocation of resources being put into this space in Canada specific. We're having conversations with some big players out there that are interested. So it's going to be an interesting year to see what happens. Just a quick map that shows the Hub City land base in red, offset by a number of peers. And there has been some M&A in the area over the past 6 months. And some of that has been fairly hush-hush in terms of who the buyers are, and there's rumors going on about who that may be. But the fact that there's M&A and the metrics are looking quite attractive, again, makes validates the resource and validates the land position that ROK and EMP hold.
So limited time commitment, and then the capital piece. Since the start of this project, ROK has invested roughly 1.5 million. For the first half, 2024, we've allocated $500,000. So again, pretty low capital commitment, and certainly time commitment for what we believe is some pretty significant potential for shareholders.
Yeah, I think based on EMP's market cap, so they're a public company as well. They're 75% ownership of this project. That's their only asset. I think they're a market cap of around $40 million, 30 or 40. So, inherently that would put the value of this project in ROK's hands at about 10 million. But again, we don't believe that's been priced into our stock at all. We don't believe anybody's putting any value on that. So at some point we do want to, quantify that and actually monetize that for our shareholders. As far as next steps in the lithium, so the PEA has been completed. We have some additional testing. We're actually in the process of doing a pilot with Koch Industries. So obviously a massive, worldwide multi-billion-dollar company. We're starting that pilot up in the next 2 weeks here in Southeast Saskatchewan. So that'll run for a few months. In the meantime, or actually kind of subsequent to that, we'll be drilling 1 or 2 more wells. We'll be testing some subsurface, testing flow rates, testing concentrations, as well as looking to delineate the play and move outward and drill some vertical exploration wells. In the meantime, we are having conversations with DLE providers, CRC, so on the refining side downstream, and looking to move forward a small commercial project sometime over the next 18 months. And EMP is leading all these conversations. We're helping and we're providing technical support when needed. So that wraps up the presentation. We do have 5 analysts covering us. So Beacon, Cormark, Echelon, 8 Capital, and Research Capital. And see, you can access their research reports. We will be coming out in April with our year-end financials. I believe April 18th or April 19th is when that'll be released. So final year-end. We provided a little bit of insight into that already in our previous press release, but obviously these 5 analysts will be coming out with updates at that time. So that's it for today, guys.
Okay, guys. Thanks a lot, man. I tell you, one thing I want to point out is on your reserve report, there's just a bunch of numbers, but I did a PV10 net asset value, subtracting out your total debt, and it comes up to a PV10 value that's more than double the current share price. And in my opinion, no publicly traded company that's profitable, generating positive cash flow enough to fund further growth should be trading below PV10 of their proved reserves when you have so much 2P, proved and probable, and a lot of stuff that could be moved into proved pretty soon. So anyway, I got a few questions here. When are you guys going to be releasing your fourth quarter audited financial statements?
That's the April 18th. So
April 18th.
Yeah, that'll be year end and fourth quarter. Yeah.
Yeah, you may have mentioned it in the deal. What's your average daily production in fourth quarter?
Just over 4,200 BOEs a day.
Okay, 4,200. Okay. this year's, I mean, last year's drilling program, it was fully funded by OpEx, right?
Correct.
Or by operating cash flow, rather.
By cash flow, correct.
Yeah. So is this year you're planning to live within cash flow this year on this year's plan?
That's the plan. Yeah, we have no intent to, to raise any capital or increase our line. Obviously things change and opportunities present themselves, but right now we have an ability to, drill, I'd say 12 to 15 or 12 to 16 wells in the second half, at current pricing. And, in a perfect world, we would have been able to kind of have a full year of that type of operations, right? And continue that growth. But I think it was prudent to pull back in light of the capital that we did allocate at the end of the year. I think we spent about $32 million. I think this year it's going to be more in that, $25 million range is my current estimate. We will be coming out with guidance for the second half of the year in April as well, where we'll firm those numbers up.
And Brian, I'll mention, sorry, Dan, just to add to the first half 2024 guidance. Part of the reason why we scaled that back was also we were watching oil prices, and oil was trending from 70 to a 6 handle. And our view was the oil wasn't going anywhere. So why not be prudent, retire debt, continue to build out the asset in terms of future drillables, smart acquisitions, and come out in the second half of 2024 with a bit more robust program. So that's kind of where we've headed. Now oil prices have cooperated, and we're hoping that we can drill a little sooner. And we think that, ultimately our cash flow will benefit that decision.
Yeah, and I'll tell you, several of the big banks down here have already increased their oil price deck. Deutsche Bank is now $90 US for fourth quarter. I think Goldman Sachs is again, pounding it, triple digit.
Goldman at 90 as well, I think.
Yeah, 90, but there's 4 or 5 RBC Capital and one other one have raised their price deck. So once I call those guys the alpha dogs, man. When they start doing it, the other guys start doing it. So we'll see. Have you seen any reduction in completed well costs up there? Because down here, all the guys I'm found, they're saying up to 20-25% decline in their completed well cost.
I wouldn't say that high. We're definitely seeing it come down. I think part of that too is efficiencies on our own part. I'd say over the course of 2023, the cost of steel came down. 2022, we were pre-purchasing all of our pipe. We've no longer needed to do that. There's a little bit more competition, access to manufacturing, et cetera. We were bringing in our pipe from China for that entire year. And now this year, we're not, we don't need to do that. We're seeing a little bit more competition on the bids. But yeah, we were in that, like for instance, on a Frobisher well, we were definitely in that 1.3 to 1.4 all-in cost. I think that's coming down to more in that 1.2, perhaps lower. I think there's some other things that we're working on the drilling side to get some of these wells drilled in, say sub 8 days on a mile-long well. And, we're seeing some of the bigger competitors really pushing that, which can shave off $50,000 pretty quickly. So yeah, there's a lot of cost savings and efficiencies happening here, Dan. And, we're going to be, it's so critical in this space, especially when you're small like us
Are you drilling, are those dual lateral wells or single laterals?
Typically dual lateral. I would say in the Frobisher, probably 80% of the wells we drill are dual. And then in the Midale, it really depends. Like there's multi-lats being drilled. You can drill up to 3 or 4 legs, or you can drill in frac. There's some optionality there.
And you're casing those laterals, right?
The laterals in the Frobisher, no, they're open hole. And
okay.
The only wells that we're casing to TD are the fracked wells where you'd case a liner in. Otherwise, it's open hole up here.
Okay. And where I saw Surge is doing some of these multilateral wells, is that around there?
Yeah, so I mentioned in the presentation in the Steelman area, Surge is drilling a number of multi-lats. Yeah, and so is Whitecap, a couple privates as well, and a lot of success in that area. So we do have two identified locations there that we'd like to drill in 2024.
Okay, because I know I think Surge did one with 8 laterals or something.
They may have. I mean, Surge, and that could be another area. I haven't seen 8 in the Steelman area, but the multi-lat and kind of that fishbone design that companies up in the Clearwater are doing, and it's little bit of a resurgence to the multi-lats, which have been around for a long time, but not, 5 to 10 laterals per well. That's new.
Have you seen this, what they're doing down here? They're drilling these U-turn wells. I find that almost impossible to believe. They're going
Yeah,
out a mile. They're going out a mile. Then they do a
that's wild.
U-turn and drill it back to all the way back.
I have not
Yeah.
seen that. The technology is incredible. What we're able to do now.
It's incredible. So then instead of, doing a 2-mile lateral where you need 2 sections, now you can on one section get the same production out of that one section and with the U-turn well.
It's interesting.
And yeah, I know that Matador, look at Matador. They've had success with that in the Permian Basin, I know.
Okay.
Anyway, some of this stuff to me, because I've been in the business for 40 plus years, is just remarkable. It's remarkable in the drilling technology. There's a couple questions here. What is the culprit decline rate that you're seeing on those Frobisher wells?
So our corporate decline rate's about 27%. And so that increased from last year where we were sitting in that 23%, 23% range. The Frobisher wells, it's such a high variance. For instance, we have, like, every area is different. For instance, in Glen Ewan, we've drilled that really strong well. The first 3 months have been, essentially flat, right? You're sitting in that 350 to 400 barrels a day, just flat. So, that will decline over time. And in that first year, you're probably going to see a 50% decline in that first year. There's other areas where, that first year of decline can be upwards of 70%. And then there's other areas where it might be 20. So it really depends. I can't really say, but corporately we're sitting at about 27 today. Of course, as you go out and you drill new wells, that's going to, creep up. But, given that we're only planning, say, 12 to 16 wells this year, I don't see a significant increase in that corporate decline rate. If anything, I see it kind of staying where it is. We do have a water flood that we began last year in October, so we hope to see a response on that, in the next 3 to 4 months, and we'll be looking to begin another water flood this year as well.
Okay. Let's look at your hedge table. You have a table in this at the end.
Sure. Yeah.
Hedges.
It's at the back. There we go.
Okay. Yeah, there you go. So you're pretty much, you're not going to hedge any more of this stuff in 2024, right? Unless maybe you could lock in 85 or something.
No. Like, we're pretty much we've completed our hedge program for the remainder of this year. We're hedged at around 75% of our production, and that's a bank covenant again. So that's just being within our constraints of our line. We're hedged. We do have another layer of hedges into Q1 of 25 that you don't see on here. Mm-hmm. But beyond that, I think this is kind of where we sit today. Really, it's a rolling 12-month option on our hedges where we were required to hedge 75%. So, for instance, as we roll off April, then we'll need to get, March of 2025 into the hedge book.
Okay, I get that. And
again, that's a bank covenant.
Yeah, I agree. There's, I get questions from our members all the time. Why do they hedge so much? Well, it's required by your bank covenants 90% of the time.
Yeah, and the one good thing is as we drill new wells, so, for instance, sitting at, what is it, Q2, 1,600 barrels a day hedged at $75. So I think our, corporate oil production's probably in that 2,200 barrel a day range, 2,300 barrel a day range. And so as we drill new wells, all of that comes on unhedged. So, we'll drill, these wells all through the second half of the year. The entirety of that volume will be unhedged.
Yeah.
So
that raises. I think for my modeling, I use production mix of 50% oil, 10% NGLs, and 40% gas on a BOE basis. Does that sound right?
That sounds right. Yeah, we're 61% liquids right now.
Okay.
And 10% NGL sounds right. Yep.
Yeah.
I'd say that's accurate. So as we bring on new wells, for instance, when we drill in Southeast Saskatchewan, we would average around that 75 to 85% liquids per well. So that corporate balance or that corporate, ratio will start to creep up on liquids over time because we don't have any plans to drill any gas wells this year.
Yeah. What's the actual gas price today at Kaybob? Like a buck?
I want to say, I don't know today. I haven't looked at spot in this week, but I'd say it's in that $1.75 range.
Oh, I'm actually surprised it's that high. Tell you the
Yeah,
truth.
and so as you see, like our hedge is well above, because this is in US pricing as well, what you're
Yeah.
looking at on the screen. So our hedges are well above our current spot price and what we receive on revenue. So the hedges on gas are in the money, whereas the hedges on oil today aren't.
Yeah, and you're getting a decent price on your propane, right?
We are, yeah. I don't know off the top of my head. I think our combined NGL, pricing is in that $55 a barrel range, 50 to 55.
Oh, okay, that's pretty good.
So it's reasonable. Yeah, the propane, I'm not sure off the top of my head what it is. Like you can see here what the swaps are at for Q2, Q3. Those were swaps that we had locked in last year.
Yeah. Well, in the U.S., I'll tell you what's happened on NGL prices. We had a significant increase in our export capacity, and there's big demand for U.S. propane in Asia and South America.
Right.
And I did some research on this a couple of weeks ago, and there's been like 40 new LPG, liquefied petroleum gas tankers added to the global fleet. So there's an extensive, and another 20 or 30 going to be added this year. So big increase. So our hope is on the gas, when we get these next 3 big LNG export facilities online in the next 12 months, 3 or 4 quarters here, we've got another 6 to 8 BCF a day of additional export capacity for LNG coming online, and that should solve this surplus that we've got. That should take care of it. And then we got several of the companies down here already announcing they're going to curtail their production, and a lot of the big gassers they're not completing as many wells this year. I don't think they shouldn't, because we're going to run out of storage capacity.
Well, yeah, I mean, we have our own issue on gas, obviously, in Canada, being more landlocked. And so the LNG plant coming online, I believe next year in BC, I think that's, 2 to 3 BCF a day of LNG takeaway. So, relieve some of that bottleneck or that stress on our, AECO pricing in Canada as well. And, long term, I think if you look at the curve and the forecast for gas pricing, it looks a lot better than, say, oil in terms of where it sits today and where it's going. Oil's backwardated versus gas that isn't. So I think there's upside in gas long term, but just today, in Canada, in Saskatchewan, Alberta specifically, it's a little bit challenged.
Yeah. What are you hearing on that Trans Mountain pipeline? Is that, last I heard, they're hoping to get it online by May, end of May.
Yeah, well, it was they were working on fill up, and then I heard there was another delay just recently. I can't remember the reason for it, but yeah, I think that is the goal still, down next few months. Yeah.
Something I saw this morning said they expect it to be up and running by the end of May, which is really going to help the differential up there, I think. Another thing down here on the gas, and this is a new thing that I just heard about I was on a New York, or not, a Washington D.C. panel, and one guy pointed out there's a huge increase in electricity demand for these data centers, for AI, and for like crypto mining and all kind of stuff. And they're saying there could be like a 30 to 50% increase over the next 3 years in electricity demand, and the only way to deal with that is more natural gas-fired power plants. They're saying there's already like 15 or 20 of them planned for the next 12 months that they have to get up and running, or they're going to not have enough electricity in some areas. So that's the long-term outlook for gas, North American gas, is pretty bright. It's just that we've had these 2 very mild winters in a row.
Absolutely.
Yeah, let me get a couple of questions. Cliff asked, why do you think the stock's been stuck in this range of, I think he's talking about U.S. prices, 19 to 20 cents. And I just think it's, people were these Canadian juniors are not getting the multiples that they deserve. I mean, here you got companies that are growing, all funded by operating cash flow. And in my opinion, they should be trading for 4 or 5 times operating cash flow. But when you got this much running room, and you got a lot of running room. I mean, right now, just on your Frobisher, identified, you've got like a 4 or 5 year inventory, don't you?
If you include identified unbooked locations, we do like in total, we have about I would say a 6-year inventory between Mydale and Frobisher. And then but Frobisher alone wouldn't be that much. It might be 3 years.
Yep.
Again, the Mydale, there's some very low risk drilling in there, and we talk Frobisher specifically because of how attractive those economics are. But the Mydale, you can get equally as attractive economics in the right areas. So, but yeah, we believe we have upwards of 175 total locations. The bulk of that is booked. And this year we're looking to drill some exploratory plays that we haven't drilled yet. We have some really attractive land that a lot of companies are paying big dollars offsetting this land, and we're going to go and take a few shots at those and try and grow some new areas. And so that's exciting for us.
Yeah, and I think Jared mentioned you guys are looking at bolt-on acquisitions in those areas, right?
And we continue to look at acquisitions, and there's a lot of, I've said this since the start of ROK, there's a lot of product available, a lot of private companies that are looking for liquidity, and there's not a lot of consolidators at our size, call it 100 barrels a day to 3,000 barrel a day consolidators. And we've evaluated them. We continue to evaluate them. I think we've had some success on some smaller ones. We've obviously done the Whitecap transaction and the Federated one, but for us, for 2023, the volatility in oil prices and gas prices caused us to pause on what probably would have been a handful of acquisitions. And, again, I think as prices stabilize or continue to trend up, we think that we can go back and grow via M&A, and we'll make that a priority or continue to be a priority heading into 2024.
Yeah.
One thing that I want to mention too, Dan, is we, since our acquisition in 2022, we haven't issued equity, we haven't raised any capital, we haven't diluted shareholders at all. Our focus has been, I think to date, we've only raised about $23 million since inception of the company. We've created a pretty attractive package with that amount of capital. I think our debt has been pulled into a very, very attractive kind of position here at 0.6 debt to cash flow. So when we're doing acquisitions, we're extremely cognizant of our cost of, debt, cost of equity, or overall cost of capital. How can we go do those acquisitions accretively? And for us, going out and issuing equity at 27 cents, 28 cents isn't what we want to do. We don't view that as a good use of equity. So, we want to, go and do these acquisitions that make sense, not pushing our debt too far. But we do definitely continue to evaluate the right ones, and there are some out there that we're looking at currently. So,
hey, do you know who holds all those warrants? Or I mean, they're publicly traded, so maybe they're moving around all the time, right?
The publicly traded ones are, who knows who owns those? Like there's a number of shareholders that participated in the raise when we did that when we did that FCL transaction. So some would still, hold those. Some of the original institutions may still hold those, but for the most part, it's impossible to know who owns the public warrants.
Yeah. And I want, to our members that are online, a lot of my forecast models, I just use, outstanding stock, because you just never know who's going to exercise their conversion rights, or who's going to exercise the warrants. You just don't know. And
right.
if you do, and this is a mistake that I see some people use in forecast, is they will use fully diluted, but they won't lower the interest
proceeds.
Yeah, they won't. If the debt got converted, your interest rate comes way down. If these warrants are exercised, would you say 30 million, or how many millions of dollars could be pumped into the company, which would wipe out all your debt? So
we'd be debt free. Yeah, absolutely. If that happened, if we were able to exercise all or even a bulk of the warrants, that we would be debt free for sure. Probably would retain some line of credit and utilize capital to go and drill wells. But yeah, I mean, it's attractive to see that capital come in. And if it doesn't, then our fully diluted number drops from 350 to 212. So it's either way, we have a strong business, and a strong forecast ahead for the company, whether that capital comes in or not.
Yeah, my point is, I just don't think warrants outstanding are that bad. That's not a bad thing, really. I mean, if they were really deep in the money, yeah, maybe, but the
I think
liquidation.
everybody has a different opinion on that. There's definitely people that view it as a significant hangover that, has been a part of the company now for 2 years. And again, we're a year away from that exercise price or
Yeah,
exercise date.
have you guys considered, instead of doing a stock buyback, go out and could you buy the warrants and retire them?
We've always talked about that internally, but it's a quick stop because the bank doesn't allow that.
Oh, okay.
So that, we would love to, and I think the way we support the stock is individually buying on the open market when we can. But yeah, corporately we have not been able to because of the bank.
Yeah.
Yeah, we don't have an ability to call the warrants either.
Yeah. Right now, what WTI oil price are you using in your 2024 budget and your?
So on the website, you'll see a $70 WTI forecast and budget for the first half. Okay. We've been creeping that up, obviously, as oil price has started to move. So I think $75, for the remainder of the first half, and then $80 thereafter.
Yeah. Bill asked here, do you have what's the market like, the physical market down there in the southern part of Saskatchewan? I imagine it's pretty good since that area's been producing for a long, long time.
Yeah, it's the market. Yeah, I mean, it's been pretty. We've been producing for 50 years. What does he mean? Sorry, what by the physical market?
Apportionment, stuff like that.
Yeah. Do you have good
takeaway capacity
market for you? Yeah, you have good access and good market. You don't have any pipeline problems like they have in the Permian or anything like that.
Access to market. Yeah, no, there's no issues. We, in the 20 years we've been operating, I think we've seen apportionment once, and that was when the Bakken was, booming in both Southeast Saskatchewan and Montana, North Dakota. So that's the only time we've ever seen apportionment. Differentials obviously move as things happen with refineries and turnarounds and things. Our differentials historically are in that $5 to $7 a barrel range US. That's transport differential. So basically from Cromer, which is where we sell our oil, comparing it to WTI at Cushing. So it's about a $5 to $7 a barrel differential versus say WCS or heavy crude where it's a magnitude higher. And then right now we did see a slight increase. We're in that $10 range currently, but that's that will come down over the next quarter.
Yeah, there's a question. I think you answered this. The drilling this year is going to be just strictly focused on the oil-prone areas, correct?
Correct.
And so as I said, the production mix should be about 60 to 61% liquids, and that's what I'm using. I'm using 50 oil, 10 NGLs, and 40 gas.
Yeah, the production mix on the new wells though will be more like 75 to 80% liquids.
Yeah, what gas price do you think you would need up there at Kaybob to make it look really good? Because they come on strong. Those are big wells.
Probably $4.
Yeah, okay.
Where we'd start to look at some capital allocation. I think some of our partners that are gas players look at lower pricing than that. But as far as ROK going out as an operator, going to deploy capital in the Montney, for instance, I think at a bare minimum you're in that $4 to $4.50 range.
$4 gas would get recycle ratios right around 2.
Yep.
So that would sort of be, I think, the bare minimum.
Okay. Do you have any non-core assets that you're wanting to sell now?
Yeah, I think over 2023 we've done a really good job, creating a core area for us, core operated area. So we've done, obviously the major disposition being the Weyburn unit, the non-op there, and then we've also sold, I'll say 5 different smaller areas, somewhere in that $3.5 to $4 million worth of proceeds. We continue to look at either dispositions for cash or swaps, where we're swapping our non-core assets for areas that we operate in. I think we've had some success in that. We believe that we're going to have success over the course of the first half of 2024. So we're always evaluating that and looking to grow. We're also looking to grow through certain farm-ins where, we make a commitment to drill a well or a number of wells and grow out some exploratory areas. So again, I think the growth with ROK in terms of the asset base continues to happen. It's just they aren't press releasable items because they're not material at the time.
Mm-hmm. Well, one thing, when I started looking at the company in the beginning, what I liked about your team was you've got experience in making transactions. buying and
Yep.
selling. And
Yeah.
and guys, that's important in this business. I just want to say that, you know, you can like, you look at your map there, we got those different areas outlined, is that you can, you know, fully developed one of those areas and then turn it, because there's companies up there that are just looking for cash flow, that are, I call them dividend paying companies, and they'll buy those fully developed assets from you, and then you can take that capital and redeploy it in an area that's got, you believe, has more upside, and go from there.
Yeah, you know, Dan, historically, when we used to build and sell to private companies, we would basically, you know, drill up an area or a number of areas, and, you know, get to a point where we believed it was at some sort of podium value. We would sell that, you know, to one of the bigger companies, a public company that needed to grow by acquisition. You know, they didn't have the inventory to grow at the drill bit. And then we would typically carve out raw land and do it again. And, you know, I think, you know, that may or may not happen with ROK, but we definitely have experience in creating entities and creating asset bases and preparing them for sale. And, you know, what goes along with that in the preparation of doing so is acquiring accretively, doing trading of assets, things like that. So yeah, it's been, you know, this company's been a lot more acquiring than some of the previous ones. But I think we put together a really attractive package in Southeast Saskatchewan that, you know, I don't think it's done yet. We definitely have some more drilling to do, and maybe some more, you know, tack on acquisitions here and there. But as far as non-core goes, I think we've sold the bulk of that in Southwest Saskatchewan. You know, a lot of questions about K-Bob. Is that something that you'd look to sell? I think, you know, the answer is yes at the right price, but, you know, given where gas is trading today, you know, that's not today.
Yeah, unless unless you're desperate, you don't want to sell at the bottom of the gas price.
Absolutely.
I mean, giving it away, because that would be prime. But, and I will tell you one thing, when I was at Hess, one of the dumbest things they did, they never wanted to sell anything. They never wanted to sell any assets. And we had like 30,000 wells. I mean, it was crazy. You're doing accounting for these little 1 and 2 barrel a day wells. It was crazy.
Yeah.
And then finally, you know, when John Hess took over total control, we sold packages. We sold off at one time 18,000 well bores in 10 different packages. And you talk about transition period. That was something else, man. I'll tell you. But anyway, okay, on the lithium thing, and I literally, I want to remind everybody, I have nothing in my valuation of the stock for the lithium deal, but I think it does have potential. One of the companies that I do follow is Lithium Bank up there, and I think Lithium Bank did sell off some projects. And what their deal is, they build up a project like that, prove it up with the PEA and everything, and then they sell it and keep like a royalty interest or some kind of a carried interest in the project. Were they the ones that sold that yellow area there?
Yeah. So yeah, good point. Lithium Bank, they press released a deal where an unnamed company wrote an $8 million check, a non-refundable deposit for an option on 3 areas. That option needs to be exercised either in its entirety on the 3 areas or individually 1 or 2 areas. And they have until March 31st. So we're watching that quite closely to get a sense of, does that happen? Who is the buyer, and what was the ultimate purchase price for, you know, 1, 2, or 3 areas? But yes, like that's part of the consolidation that's happening. The other piece is there's been transactions where privates like Prairie Lithium sold to Arizona Lithium for $80 million, undeveloped acreage, slightly more acreage than what we currently have, but I don't believe as quality as acreage as we've got. But, you know, so again, there's transactions that are happening that we believe validate the lithium space, and we believe it's going to attract global capital.
Yeah. You mentioned Koch Industries has something to do with one of these. I have a very high level of respect for Koch Industries. We did deals with them at Hess, and they were always first class. Yeah.
So Koch's one of the DLE providers that we're working with, and so there's there's more than a handful. There's many companies working on DLE, direct lithium extraction technology, across the world. And we've talked with a number of them. We've narrowed it down to Koch and a company called ESM out of California. And we've done multiple testing with both parties. And now Koch, we're just beginning commissioning of a pilot plant. It's already on site. It's basically built over the next 2 weeks. And so that will run on site for about 3 to 4 months. And
Okay.
yeah, Koch's, I mean, they're obviously a massive company, first class. They have offices all over the world, and they have an office and a lab in Pickering, Ontario, which we've been sending Brian to. And they worked with us on our PEA as well. So, you know, it's a very reputable company with deep pockets that can, you know, move things, you know, quite quickly once they want to get behind something.
Yeah, they have a big interest in something in Arkansas down here in the
Standard
state.
Lithium.
Yeah,
Yeah.
with Standard Lithium, and I think they've committed.
100 million, I think.
Yeah, it's $100 million or something to that project. And based on what I know about Koch, they don't throw money at stuff just for fun. They've done a heck of a lot of research on this, and that's a big direct, DLE, direct lithium extraction project down there. So there's some, headlines and stuff coming out on this that could draw a lot more attention to it. I think, the bad thing is that the lithium prices come down a little bit, but there's still going to be big demand for lithium in this world. That's for sure.
There is. Yeah, there was a report that recently came out. Can't remember who published it, but yeah, the outlook for lithium is quite strong. As everybody knows, it's just there is a lot of it out there, and I think the most economic plays, just like oil and gas, are going to get the capital, and the larger in some ways the better. But I think when it comes down to quality over quantity, I think there's value there, and I think that's what we have.
Yeah. Okay, I think we'll end it here, and I'll just tell everybody we're going to publish an updated profile on the company soon after, just days after they release their fourth quarter financial results, and then I think that'll be a catalyst. I think when you do announce your 2024 drilling program, that'll be a catalyst, and obviously anything that comes out on this lithium project could also draw more attention to the company. But the numbers look very good, and we're up to over 4,000 barrels a day, that's more production what the Hemisphere has. So anyway, and appears you got a lot of running room that'll keep this growth going on. So thanks a lot for hosting, and we are doing the luncheons again down in Houston. So if you guys want to come down, May or June or something to host a luncheon, we are drawing more people. We moved our luncheon to a different location. It's called Maggiano's. Very, very good food, and again, a great location. So
sounds great.
We have one Thursday with U.S. Energy Development, and we're expecting like 50 or 60 attendees for that one. So anyway,
Cam and I really enjoyed that last time, Dan. So we'll be in touch, and we'll likely come down again.
We've been ramping up our marketing efforts as well. I know we're heading out east in Canada, but also going to Atlanta and Florida. So you'll see us around, and hopefully you find a way to connect in Houston.
Trying to get a little bit more U.S. exposure, so that because the volume on our U.S. side is quite low. So we're definitely trying to get get in front of some investors down in the U.S.
Well, this will help. I'm telling you, when this goes out, it'll go out this afternoon. The thing, it'll get a lot of looks. Some of ours, once they go public on YouTube, have gotten over 1,000 views. So they first go out as private for EPG members only for a couple of weeks, and then they go total. And of course, we'll send you the link, and you can use it as much as you want and send it to whoever you want to. So
fantastic.
All right.
Great.
Well, Sabrina, why don't you end it here, and then thanks again, guys. Thanks for doing this.
Yeah, of course.
Thanks, Tim.